Welcome to Iron Financial. This is the only place dedicated to helping you forge a stronger portfolio and cut right through all the market noise. Today, we are putting single-family rental giant AMH under the microscope. You see, they just dropped some news that has the market talking, a big, big promise to their shareholders.
And we all know promises are cheap, right? They're only as good as the foundation they're built on. So today we're going to go way past the headlines to ask that one critical question. Is AMH's financial house truly in order, or is this a structure that's on the verge of cracking?
Okay, so it all starts with this one number right here, 10%. Now, in a market where every single basis point is fought for, a double-digit jump like this, it's like a flashing light. It's a signal of immense confidence coming straight from a company's boardroom. It's basically a declaration that things are going well, and they expect them to get even better.
Or it's a distraction. A big, shiny number to get investors to look one way while the real story is happening somewhere else entirely. The real question is, what is this 10% really telling us? Is it a true sign of strength, or is it just a calculated gamble?
And this is the headline move, a full 10% hike in their quarterly dividend. For anyone who might be new to this, that is a direct pay raise for every single investor holding the stock. It literally means more cash hitting their brokerage accounts quarter after quarter. On the surface, it's an incredibly powerful signal of financial health and commitment to shareholders.
And I'll grant you that. Cash in hand is always compelling. No one's going to argue with that. But, a raise you can't afford isn't a sign of strength. It's a sign of desperation. So we absolutely need to know if the cash flow engine under the hood can actually support this new payout.
And that brings us right to the core of our inspection today. A big dividend hike is the perfect fresh coat of paint. It makes the entire structure look new, stable, and incredibly attractive from the outside. But our job here is to see if that paint is hiding any stress fractures. We're not here to just admire the curb appeal. We're here to check for termites in the wood and cracks in the concrete. So let's grab our hard hats and inspect the financial foundation to see if this structure is really as solid as it seems on the surface. So here's our blueprint for this explainer. First, we'll examine that 10% promise in detail. Then, we're going to go under the roof to really understand the business model that's supposed to be generating all this cash.
And after that, the crucial part, inspecting the financial foundation, which means we are digging deep into the numbers. Then, we'll look at their official blueprint for 2026 before we deliver our final verdict. Is this company truly built to last, or are we looking at a house of cards?
All right, section 1. Let's start with the headline that really caught everyone's attention. What are the exact details behind this very attractive 10% dividend promise? Let's break down the mechanics of this payout. The numbers themselves are pretty straightforward. The company boosted its quarterly payout from 30 cents per share to 33 cents per share. Now, I know what you're thinking. 3 cents might not sound like a lot in isolation, but this is a game of scale. AMH has over 430 million shares outstanding. So you do the math. That's an additional cash payout of nearly $13 million every single quarter. That works out to over $50 million a year. That is a significant new commitment.
$50 million. Now that's a real number. That's cash that can't be used to pay down debt, or to buy back more stock, or to reinvest in the business. They are telling us right now that this is the absolute best use of that capital. I have to say, I'm not convinced just yet.
And for investors, these are the dates that really matter. You needed to be a shareholder of record by the close of business on March 13th to qualify for this new higher rate. The cash itself then hits accounts on March 31st.
So the check is in the mail, so to speak. This shows the company is moving quickly to turn this promise into a real payout. They want investors to feel that cash in their hand, which, of course, reinforces the perception of stability. But again, and I'm going to keep saying this, it all comes down to whether the business can back it up, not just for this quarter, but for the next 10.
Okay, a dividend is a promise, and that promise has to be backed by a real business. So let's go under the roof and really understand the model that's supposed to support these payouts. What does AMH actually do to generate the cash to fund this dividend hike? Okay, first things first, the legal structure. AMH is a real estate investment trust, or a REIT. Now, what's really interesting about this slide is the legal requirement that's baked right into that structure. To maintain their favorable tax status, REITs have to distribute at least 90% of their taxable income back to shareholders in the form of dividends.
And this is an absolutely crucial point. For a normal company, paying a dividend is a choice. For a REIT, it's an obligation. This is why dividends are so central to evaluating a company like this. They can't just turn off the tap if things get tight without facing massive consequences. So their hands are tied, which makes the sustainability of their income even more critical.
And this brilliantly illustrates their specific corner of the real estate market. They aren't in volatile office buildings or struggling shopping malls. AMH is all about single-family homes. They own them, they operate them as rentals, and crucially, they also develop and build them from the ground up. This gives them an incredible amount of control over their pipeline of new assets. And they execute this model on an absolutely massive scale. We're talking about a portfolio of over 60,000 homes. That makes them one of the largest residential landlords in the entire country. And their integrated approach means they control everything from the first shovel of dirt to the final lease signing.
Okay, let's just pause right there for a second. 60,000 homes is an enormous operation. That means massive exposure to property taxes, insurance costs, maintenance bills, all of which are inflating like crazy. A portfolio that big is not nimble. How in the world do they manage that risk?
Well, that's where their focus on new construction becomes so critical. They delivered almost 500 new homes in just the last quarter of 2025 alone. You see, newer homes have lower maintenance costs, and they can command higher rents, which helps to offset the inflation on their older properties. They're even funding this expansion with nearly $600 million from something called a green bond, tying their growth directly to building more energy-efficient properties, which also helps lower long-term utility and upkeep costs.
A green bond? It sounds nice, but is that just marketing fluff or does it actually improve their borrowing costs? And let's be honest, is 500 new homes a quarter really enough to move the needle on a 60,000 home portfolio? It kind of feels like trying to bail out a battleship with a bucket.
And now for the main event. We've seen the dividend promise, we've seen the business model. It is time to check that financial foundation.
This is where the truth comes out. Forget the press releases and all the glossy photos of new houses. Let's look at the actual numbers behind the walls to see if they can truly support the weight of these $50 million a year promises.
Okay, before we look at any charts, we have to understand the single most important metric for a REIT, core funds from operations, or FFO. You can't just look at standard net income for these companies because real estate accounting includes these huge non-cash charges like depreciation. FFO adds that back in to give you a much, much clearer picture of the actual cash being generated by the rental business. So the crucial point is, this is their lifeblood.
Right. So in simple terms, it's the number that tells you if the rent checks coming in are actually more than the mortgage, tax, and repair checks going out. Everything else is just accounting noise.
So how is that lifeblood flowing? Well, it's growing. This chart shows their core FFO per share went from 45 cents in the fourth quarter of 2024 up to 47 cents in the same quarter of 2025. That's a 4.4% increase. Now, it's not a massive jump, but it is a steady positive trend. It shows the core business is incrementally more profitable than it was a year ago. This is exactly what you want to see.
Steady is good, I'll agree with that. But a 10% dividend hike on the back of 4.4% FFO growth, the math already feels a little aspirational, doesn't it? The raise is more than double the rate of their core profit growth. That to me is a potential red flag right there.
And this is exactly where the story gets more complicated, and your point becomes even sharper. So the good news is, over here on the left, their core FFO was solid and it met expectations. Total revenue grew over 4% from the previous year, and the official GAAP net income was stable. This is the story the company wants you to hear. But on the right, we have the first potential cracks in that foundation. That revenue number, while positive year over year, actually missed Wall Street's expectations. That means the so-called experts who follow this company day in and day out thought it would be better. And even more puzzling, their total portfolio of homes actually shrank by over 300 properties in the quarter. Why is a landlord that's supposed to be growing selling off its income-generating assets? This is a question we need to answer. And here is the number that gives us the most pause. A dividend payout ratio, based on net income, of over 100%.
Whoa, whoa, whoa. Stop right there. 101.7%. So, in simple terms, this means that based on official accounting rules, the company is paying out more cash in dividends than it's actually earning in net income. How is that even possible? Is that sustainable?
Well, this is where that FFO metric we talked about comes back in. Their FFO does cover the dividend. However, a GAAP payout ratio this high is a flashing yellow light. It signals that there is almost no margin for error. Any unexpected spike in expenses or a dip in revenue could put them in a very, very difficult position. The financial cushion is razor thin. So given those tight margins and those mixed results we just saw, how does AMH plan to build for the future? How do they justify a dividend hike when the numbers look this tight?
Right. This is what I want to see. They must have a plan, right? Let's look at their official blueprint for the year 2026 and see if it actually holds up to scrutiny.
This table lays out their own forecast for the full year. They expect core FFO, that key lifeblood metric, to land somewhere between $1.89 and $1.95 per share.
Hold on a second. Let's look closer at the two lines below that. Now, what's really interesting here is the relationship between their own projections for revenue and expense growth. Look at the low end. Revenue growth of 1.25% versus expense growth of 1.75%. Now look at the high end, 3.25% revenue versus 3.75% expenses. In their own guidance, they are literally telling us they expect their costs to grow faster than their sales. That sounds like a guaranteed recipe for shrinking margins.
You're right, that margin pressure is crystal clear, and this slide shows their three-step plan to try and navigate it. So step one answers our earlier question about the shrinking portfolio. They call it recycling capital. They plan to sell between $400 and $600 million worth of existing, likely older, properties.
Recycle capital is a nice corporate term for we have to sell assets to fund our operations and growth. What happens if the housing market dips and they can't get their target prices for these homes? Does the whole plan just fall apart?
That is the primary risk, no question. But if it works, step two is to use that cash to fund the construction of 1,300 to 1,500 brand new homes, which, as we discussed, should be more efficient and command higher rents, ultimately improving those margins. And then step three, they continue to reward shareholders, not just with that higher dividend, but with share buybacks. They already bought back $115 million worth in January alone. So we've seen the promise, the business model, the financials, and the blueprint. It's time for the final assessment.
This is it. When we weigh all the solid pillars against the potential cracks we've uncovered, is this structure truly built to last, or is it one bad housing report away from being in serious trouble?
First, let's hear from the company itself. Their official statements express total confidence, a stated belief that their strategy of building and acquiring new homes will be the engine for continued growth. This is the optimistic case that they are presenting to the market.
Of course they're optimistic. It's their job to be. But belief doesn't pay the bills. Cash flow does. Let's get to our own verdict.
Okay, so here's our final assessment. The solid pillars are undeniable. Their core cash flow, that FFO, is growing steadily. They have a very clear strategy that's centered on modernizing their portfolio through new development. And their commitment to shareholder returns via both dividends and buybacks is aggressive and unambiguous.
But the potential cracks are just as real, and they cannot be ignored. The revenue miss tells us the business isn't firing on all cylinders, and that razor-thin dividend coverage based on net income suggests there is absolutely no room for error. Their entire strategy is a high-wire act. It's a bet that they can sell old assets at a good price to fund new construction, all while keeping those bigger dividend checks flowing.
Which leaves us with this one critical question for any investor. AMH is trying to build a skyscraper and pay for a party at the exact same time. It's an ambitious blueprint for sure, and if they pull it off, investors will be handsomely rewarded.
But if is doing a lot of heavy lifting in that sentence. If the economic winds shift, if interest rates stay high, or if the housing market cools and they can't sell those older homes for top dollar, is that blueprint strong enough to prevent the whole structure from shaking? That is the multi-billion-dollar question you have to answer before you invest. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.